Well, midterms, Fed, crude, what does all of this mean for the global financial markets that are already, well, under a bit of a corrective mode? Let's ask Andrew Freris, he's CEO of Ecognosis Advisory Services, who joins us right now on the phone line from Hong Kong. In a bit, Hans Goetti would also be joining us from Singapore. But Andrew, good morning. Thank you so much for taking the time out. How have you read into the Fed's statement? There were a couple of changes from the September statement, but nothing too untoward, I thought.
Absolutely. They are very much standing pat on what they said. The economy is strong. Unemployment is historically low. Earnings are increasing. There are all signs of inflation likely to hit above the 2%, modified, however, by the strength of the US dollar. Therefore, they're going to raise interest rates. Never mind what Trump says. Again, unlike a lot of other central banks, and I'm going to clear my throat here, we're not far away from one of them which is under pressure not to do things. Again, the Fed is going to do exactly what they said they're going to do. Trump can always threaten, but I don't think he would dare interfere bluntly and obviously, because he cannot actually remove the chairman of the Fed unless there is a particular judicial process. So leaving the politics aside, Fed on course to raise interest rates once again in December.
The question mark, Andrew, I think that is on the minds of people is there a possibility of a faster trajectory of rate hikes in 2019 because of the data that is coming in from the underlying jobs market? The unemployment rate keeps on dipping and the job markets keep on looking stronger, which means that wage inflation could rise faster than what people currently anticipate.
Well, actually, I never thought that the Fed is going to stop in year 18. In other words, they will put another 25 basis points in around Christmas and then that's stopped. No, I would not be at all surprised, given the existing trends, that they will go for two more hikes. In other words, they will add another 50 basis points in the course of the year 19. And the markets, to a great extent, I won't say they have priced that in, because markets never price anything in. They react in whichever way the mood takes them. Okay, but there will be no surprises. In other words, if we're having this conversation in February, I will never tell you I told you so, but I will tell you not surprised that they raised again.
Interesting. Let's get in Hans Goetti in this discussion as well, along with Andrew Freris. Hans, good morning to you. I was just looking at the statement and the language, and from the previous statement wherein they mentioned that household spending and growth of business fixed investment have both grown strongly. From there, the statement has changed to their point that the growth of business fixed investment has moderated from its rapid pace earlier in the year. Do you read a lot into this, or is this just a standard statement, according to you?
Well, you could read into it the fact that corporations, instead of spending money on capex, they have bought back their own shares. And I think the trade war would probably even increase that kind of thinking, because it lowers the visibility for corporations. So that's one possibility. But as to Fed policy, I mean, according to Fed Chairman Powell himself, I mean, he said that in early October, that the neutral Fed funds rate is around 3%, and that would suggest further rate hikes. And usually the Fed does not stop at neutral, usually tends to overshoot on the upside. So I think a rate hike in December seems to be a sure thing, and then possibly another 3 in 2019. So the Fed thinks the economy is strong. I'm not so sure about that, to be honest with you, because at some point these rate hikes will have a slowing effect overall, and at the same time we also have a rising inflation, not to forget. So we'll be looking at a little bit of a stagflationary environment, which will put the Fed into a possibly difficult position in 2019.
Hans, what does all of this mean for flows into EMs? Now, we were just looking at the Bloomberg data. After shunning the Indian bond markets for a major part of 2018, FPIs have returned over the last 8 or 9 days. They've pumped in some money into the Indian debt market, maybe because of the falling crude prices and the macros not looking like worsening. But if the Fed stays on course for what is said and doesn't do it more aggressively, is that something that is priced in by the emerging market bond markets?
Well, to some degree it is, but if the Fed really is hell-bent on raising rates above the neutral rate, then I'm not so convinced. I think for now, you had the sell-off in October, and I think there might be some flows back into emerging markets. But, if the Fed keeps raising rates, the dollar will increase, and then in the medium to long term, this is detrimental to emerging markets. I'm not convinced that we're out of the woods yet here.
Interesting. Andrew, what is your view out here? I mean, some flows into Indian debt markets. I don't know what's happened across the Asian region, but what's your thought on fund flows?
There was a mild improvement on the rupee forex rate. In other words, it strengthened, but very, very mildly because we're still in the 70s. And I'm afraid if I look, and after all, this is Bloomberg, if I look at my Bloomberg screen on the equities side, it's just a sea of red. Practically every single developing and developed market, except for the United States, is year to date down. So in other words, we're literally at the end of the year, and if you put some money at the beginning of the year, right now, you would have lost money. Now, in the case of the emerging markets, there are differentiations in terms of losses. In other words, for example, Straits Time, the Malaysian index, to some extent, the Sensex have fallen less than other indexes, such as, for example, China, which was one of the worst performing. So one could have not made money, one could have lost less money by concentrating in some of the smaller markets. But, our business is to tell the clients how to make money, not to lose money. And right now, of course, the answer is if you are on equities, don't add most definitely. Again, and if you're not on equities, most definitely do go into equities right now. And the differentiation between fixed income is also very, very wide because the outlook for United States Treasuries has to be bad, okay, given that the Fed is going to increase interest rates. Yields will be going up and prices will be coming down. It's a very awkward place, very awkward place. Sometimes I feel that for the next 3 to 5 months, I wouldn't mind telling my clients to stay in cash because at least some of the deposit rates in the United States are likely to offer a relatively safer, and I would say fantastic performance, but better than losing money.
Yeah, well, I've heard a few people in India dedicated fund managers also speak that about India in particular. But, the last question on this conversation, and that's to Hans Goetti. Hans, what's your view on India now? The fact that crude has come off quite rapidly as well, and with what the Fed is saying, as things stand, with whatever little you can price in from the US Fed, from oil prices and the macros, are you net bullish on India or are you neutral on India?
Well, within the context of emerging markets, I think there are some reasons to be bullish on India, at least on a relative basis. First of all, India is a lot less tied into the global supply chain, so a lot less affected by the trade war between the U.S. and China. And crude oil, I think, has corrected enough. There's going to be an OPEC meeting very soon, so I would maybe expect some action there. So I think in terms of crude, that has been a positive for India. Maybe we could see some kind of either stabilization or an increase, which of course would be a headwind for India. But overall, I would think that given the earnings outlook for India, I think on a relative basis, the Indian market should do okay within an emerging markets context.
Okay. Gentlemen, both of you, thank you so much for taking this early morning call and appreciate your time on BloombergQuint today.